We are going to look at, remember I showed you the syllabus and the course outline. So we are going to make sure that we cover all that. So I'm going to introduce you to financial accounting. So first of all, you need to know the nature and the purpose of accounting. And that is what is what? Accounting. So basically, accounting is the process of recording, classifying, summarizing, and interpreting financial transactions to provide useful information for decision making. So as an entrepreneur, you need to know how you can actually be able to record transactions, how you can actually be able to classify transactions, how you can be able to summarize, how you can be able to interpret financial transactions, and be able to provide useful information so that you can be able to make a decision for your enterprise. So the purpose of actually accounting is basically to be able to provide financial information to stakeholders, to be able to help in budgeting and planning, and also controlling, because entrepreneurship also involves budgeting, involves planning, and involves controlling. So it's basically also to ensure there is proper management of business resources. For example, and again, you can also use accounting to meet legal and tax obligations. For example, things to do with filing with KRA. For example, if you have a salon somewhere, you can actually be able to record its daily sales, expenses, purchases, so that at the end of the month, you can be able to prepare a profit report to see if it is actually making what? Money. So the objectives of accounting is basically recording transactions, and that is accurate records of sales and purchases. The other thing is to actually be able to determine profit or loss, and that one means that knowing if a business is making or losing what? Money. Another thing is determining, the other objective of accounting is to determine financial position, and that one means knowing the asset base, knowing the liabilities, that is people you owe money, and also knowing the capital, determining the capital of a business, whether it has increased, whether you need to add, and so on. And also it aids in decision making. So that one means that if you want to invest or expand a business, or whether you should be cutting costs and so on. And also the importance of the objective of accounting basically is to have legal compliance, for example, for KRA and also regulatory purposes. And the other important objective of accounting is basically safeguarding assets, tracking things like resources like cash, stock, equipment, and so on. That's something else that you should know about the uses of account information and their needs. So for example, if you're talking about business owners, you need it so that you can be able to know whether you're making a profit, and also to know the financial health, whether the business is growing, whether your financial status is we are in a good position, and also whether the business is sustainable, since you guys were aspiring to be entrepreneurs, and or maybe you're entrepreneurs. And also for the managers, the account information will assist in planning, budgeting, and also cost control. And for the investors, it will act, and also investors or shareholder, it will also assist in return on investment to see whether money is coming in to the investment, and whether the business is profitable. And to the lenders, let's say banks, it will actually be able to assist banks to in terms of ability to repay loans, asset health. So that one, they look at the cash flow, they see how much you actually qualify in terms of loans and all that. So basically, they look at the financials and how well you track the finances of the enterprise. And for the KRA, that is Kenya Revenue Authority, for the tax calculations, how much you're supposed to submit, things to do with the VAT, pay as you earn, so that you don't have discrepancies and you are penalized. So the other thing is employees. So for the employees, it is all about the job security, it's all about bonus, whether they are going to get bonus based on the profit that is earned, the bonus potential. And for the suppliers or creditors is to be able to see whether you have ability to actually be able to pay the debts. For the customers, is all about liability of the business, that is the long-term supplier. And for the government, is all about economic data, taxation and regulations. And that's why it is very important. That is the importance of account information, especially now for the users, and also the information that is needed. For the government, they need it for data, economic data, taxation, regulation. For the customer, they need it for whether the supply is reliable or will be closing tomorrow or something. If you're talking about the creditors, you want to know whether they will be able to pay debts. For the employees, they're talking about the job security, whether the business is going to continue and so on. Now, let's talk about the qualities of useful accounting information. One is all about relevance. It helps users to make decisions. The other thing is reliability. That is free from errors and bias. So meaning you have the information that you can easily be able to rely on. You can make decisions because now you are free from errors. So meaning the decision you are making, it is the decision that you can actually be able to use it. You can actually be able to use it because it is free from errors. It is not biased. And you can actually be able to compare it. Let's say it is giving the history, like over time and also between the farms. So meaning you can actually be able to compare between what was the performance of maybe the past year, the current year, the graph, whether it's performing, and also the information that is normally provided in accounting is consistent in such a way that it is the same accounting methods normally used. Like when you talk about the trial balance, things of profit and loss, use the same method. So meaning that you can actually be able to track the information. So meaning you are not going to have varied information because you have got the standards that you are using to track the financial or accounting information. And then the other thing is understandability. So information that you're going to get is from accounting is that it's going to be very simple and very clear. And then also it has got what we call the timelines that are normally provided. So meaning you can easily be able to get information on demand. Like for example, you want, let's say the cash flow maybe from January to let's say May, you can easily be able to get it because now it has got what we call the timelines. For example, you talk about, let's say a supermarket must submit accurate sales report to KRA before the tax deadline. And that is things that are normally very important, especially now when you're dealing with what? Finances or accounts. So let's look at accounting concepts and principles. Accounting concepts and what? Principles. Accounting concepts and principles. You can see we have got a relevance, liability, matching concept, timeliness, neutrality, and all that. So when you're talking about accounting concepts and principles, so these are basic rules that guide accounting practices. For example, you have got a principle of basic entity, business entity, I mean. So this one treats business owners as a separate entity. That's why they normally say that you have to actually to respect business because business basically is separate from the owner, a separate entity. For example, a shop owner doesn't just mix personal and shop money because you have to separate it. And then we have got another principle of going concern. That means that businesses will continue operating. It's not like, for example, in Nairobi Farm plans 5-year budget. And then you have got what we call money measurement. So for the money measurement, we are talking about only measurable in monetary terms is recorded. So you only put what you call monetary money measurement that is only measurable in terms of money that is normally recorded. So record sales in shillings, not customer feedback. So if you're talking about recording sales, you only record in terms of what? Shillings. That is monetary value, but not in terms of customer feedback. Then the other thing is cost principle. That means that you record assets as the purchase what? Price. So like for example, you can talk about land bought in Eldoret at let's say 2 million Kenya shillings is basically recorded at that price. And then there is what we call accrual concept. Accrual concept, which is very common, is recorded income or expense when they occur, not when cash is what? Paid. For example, let's say Mombasa Hotel records December rent, even if paid in January. So then you have another concept of consistency. So consistency is basically saying that use the same method every year. Let's say same depreciation method is used for annually, so that now you have got a standard way of what? Recording. And then we have another that is what we call matching principle. So the matching principle is that match revenue with related what? Expenses. For example, you can talk about salaries related to January sales recorded in what? In January. So those are basically some of the accounting concepts or principles. So the other thing is accounting standards and their importance. So first of all, we need to understand what are accounting standards. So these are basically rules and guidelines that standardize accounting practices. So let's talk about the standards there. So when I talk about the accounting standards and the importance, we are basically talking about rules and guidelines that standardize accounting practices. So financial reports are understandable and comparable. So the importance of this one is that it can actually be able to enhance credibility and transparency, because now specific standards have been followed, and that means that is the information that can easily be able to be relied on because of the standards have been followed. The other thing, it protects users from misleading information, and then it promotes consistency, and also it ensures there's a lot of compliance with international and local laws. For example, we can talk about in Kenya, companies follow international financial reporting standards and may assign with ICEPAC, that is Institute of Certified Public Accountants of Kenya. Now, just to introduce you to something small, and that is accounting equation. So the foundation of a double entry accounting is that assets is equals to liabilities plus what? Minus what? Equity. What does that mean? First of all, you need to know what an asset is. So an asset is what the business owns. For example, you can talk about cash, so that is a current asset, then building, fixed asset. Then you have what you call liabilities. So this is what the business owns. So owes, things to do with loan and creditors, the suppliers, people who the company is supposed to pay. Then you have got owner's equity. Owner's equity is the owner's claim on business, things to do with and how do you get that? You basically take capital, you add a profit, and then you minus what? Drawings. For example, assuming that you have a cyber cafe, let's say in Nakuru, which has got a cash over 50,000, computers of 100,000, loan from bank which is 80,000, and owner's capital of let's say 70,000. Now, if you have to calculate the asset, it will be liabilities. It will be liabilities plus owner's equity. So that means that assets, from the asset, we can talk about because now we're talking about liabilities. So the liabilities we have is what? Loan from bank, which is 80,000. Then owner's equity, which is capital, that is 70. So when you add, that one gives you 150, which is what? The asset. So this is just the introduction part of financial literacy topic. So we'll be dealing more with knowing the accounting cycle, the income expense, asset, liability, the purpose and the benefit of accounting, the source documents. You need to understand the purpose of a receipt, the content, the bill, the invoices, and so on.